Did you hear what just happened in the silver market? It's wild. The market was humming along just fine, then bam! A massive, unexpected sell-off hit everyone like a ton of bricks. We're talking panic selling, prices plummeting, and everyone scrambling to figure out what was going on. For hours, nobody had a clue. Was it a glitch? A coordinated attack? The theories were flying everywhere. Then, the truth came out, and it's even crazier than anyone imagined. It all started with a totally routine, boring SEC filing from a massive global manufacturer. You know, the kind of document that usually puts you to sleep. But some eagle-eyed analyst dug deep into the footnotes and found a bombshell. This company, a huge industrial consumer of silver, had secretly been phasing it out for years. They'd developed a new, cheaper alloy to replace silver in all their products, and had been stockpiling the metal. Once they had enough of the new material, they started quietly dumping their massive silver reserves onto the market. This single filing revealed that a huge chunk of industrial demand for silver had simply vanished. The market went into a complete meltdown. It just goes to show you, sometimes the biggest market movers are hidden in plain sight, buried in the fine print. What a crazy day. Thanks for watching, and don't forget to subscribe for more market deep dives. Inside that filing, however, was a short disclosure with long-term consequences. Buried within supporting attachments was a paragraph explaining that Samsung held approximately 340 million troy ounces of silver and intended to dispose of that inventory over a defined period. The language was technical and unemotional. There were no warnings and no predictions. It simply stated a fact. Samsung no longer required silver for its electronics manufacturing and would sell the inventory through direct sales and market transactions. To understand why this matters, it is necessary to understand how markets process information. Most participants react to price movements. Some react to headlines. Very few read original documents. Regulatory filings are long, detailed, and written to satisfy legal requirements, not to attract attention. As a result, critical information often sits in plain sight, unnoticed. Samsung's filing followed this pattern. At first glance, the disclosure looked ordinary. Large manufacturers regularly adjust inventory and update materials. Nothing about selling raw materials appears unusual on its own. What made this disclosure different was the scale involved. 340 million ounces of silver is not routine inventory. It represents a volume large enough to influence global supply. It reflects years of industrial demand. It is a quantity that cannot be liquidated without affecting prices. Yet, because the disclosure appeared inside a routine filing, the market treated it as background noise. This was not because the information was hidden. The filing was public. Anyone could access it. The failure was collective inattention. Modern markets prioritize speed over depth. Algorithms react to headlines, not footnotes. Analysts rely on summaries. Investors assume that if something mattered, it would already be discussed. When information does not arrive in a familiar format, it is often ignored. Institutional investors understand this weakness. They know that major strategic shifts are often disclosed quietly. Companies do not announce transitions loudly when doing so could move markets against them. Regulatory filings exist to meet disclosure rules, not to educate investors. From that perspective, Samsung's filing was deliberate. It was accurate, compliant, and placed where it would attract minimal attention. The importance of the disclosure lies not only in the amount of silver involved, but in what it implies. Samsung is not a speculative trader. It does not act on short-term price movements. It plans years in advance. When a company of this scale decides it no longer needs a material, that decision reflects a structural change, not a temporary adjustment. The critical question is not whether silver prices might decline. The question is why Samsung no longer needs silver at all. That question does not begin with markets. It begins with technology. Samsung's filing signals that silver, long considered essential to electronics manufacturing, has been replaced internally by an alternative. That replacement changes long-term demand assumptions. Combined with the scale of inventory being sold, it creates a supply-demand imbalance the market is not prepared to absorb. At the moment the filing was submitted, silver prices reflected optimism. Traders assumed demand would continue. Investors assumed shortages would persist. Analysts assumed the future would resemble the recent past. None of those assumptions accounted for what Samsung had already completed. Structural market changes do not begin with panic. They begin quietly. They begin in documents. They begin when demand disappears before prices respond. January 25th, 2026 did not feel significant, but it marked. Have you ever wondered how a corporate giant like Samsung operates behind the scenes? Well, for years, something incredible was happening right under the market's nose, and almost no one noticed. Between 2020 and 2024, Samsung was quietly buying massive amounts of silver. Year after year, the company bought large quantities, but the market just saw a major electronics manufacturer getting raw materials. After all, Samsung needs silver for everything: phones, tablets, semiconductors, you name it. Buying silver was just business as usual, right? Wrong. What analysts missed wasn't the purchases themselves, but their incredible consistency and scale. We're talking 60 to 70 million ounces every single year, without fail. To the outside world, this just looked like regular demand. But inside, this is a common pattern among large, well-capitalized firms. They act first and explain later. Markets tend to move in the opposite order. What makes Samsung AS behavior particularly important is that it challenges a long-held assumption among silver investors, that industrial demand is stable and predictable. For decades, silver's role in electronics was treated as permanent. Analysts assumed that as long as technology advanced, silver demand would grow. Samsung's accumulation strategy suggests the opposite. It suggests that the company saw silver as a transitional material, useful for a time, but ultimately replaceable. That insight was not priced into the market. From the outside, Samsung looked like a loyal, long-term silver consumer. In reality, it was preparing to become a seller. The moment that shift occurred, silver's role in Samsung's balance sheet changed from asset to liability. Holding silver no longer served a productive purpose once the alternative technology was ready. At that point, liquidation became inevitable. The market tends to believe that large corporations act slowly. That belief creates complacency. Samsung's timeline contradicts it. The company spent years preparing, then moved decisively once the transition was approved. This is where asymmetry appears. Samsung knew exactly when it would stop. Markets are accustomed to falling prices. They are not accustomed to disappearing demand. The difference between the two is often misunderstood, and that misunderstanding is costly. Price decline is cyclical. Obsolescence is permanent. Samsung's January 2026 disclosure belongs to the second category. For decades, silver was considered essential to modern electronics. Its conductivity, reliability, and manufacturability made it the default choice for circuit connections and components. Because of this, investors assumed that silver demand was structurally protected. Even when prices fluctuated, the underlying need for silver appeared stable. That assumption no longer holds. Samsung's decision was not based on market prices. It was based on engineering outcomes. Inside its research divisions, the company reached a conclusion that markets had not yet absorbed. Silver was no longer the most efficient solution. This is how technological displacement begins. It does not start with falling prices. It starts with internal research programs that quietly succeed. Samsung spent years developing an alternative conductive material. The objective was simple but ambitious: match or exceed silver's performance while reducing cost. This effort was not speculative. It followed a defined roadmap supported by long-term funding and isolated from public attention. By the time the market became aware of silver in electronics is now facing the same process. What makes this transition particularly disruptive is timing. Samsung did not announce experimentation. It announced completion. The research phase was finished. Validation was complete. Production readiness had been approved. There was no uncertainty left to price. Markets prefer gradual change. They struggle with binary shifts. The moment a technology becomes viable at scale, demand does not taper. It drops. Samsung's filing indicates that its silver demand goes from significant to zero within weeks. That is not a reduction. It is elimination. For the silver market, this changes how future demand must be modeled. Electronics was not a marginal consumer. It was one of the largest and most stable sources of industrial demand. Removing it alters the balance between mining output, recycling, and investment flows. This is why price charts alone are misleading. They reflect past transactions, not future necessity. By the time prices respond, the demand that supported them may already be gone. Samsung's role as an industry leader compounds this effect. Other manufacturers observe its decisions closely. When a market leader validates a new technology, competitors accelerate adoption. The transition does not remain isolated. Once graphene is proven in mass production, silver's role in electronics becomes temporary for everyone. This creates a feedback loop. As more companies prepare to transition, markets can ignore opinions, narratives, and warnings for long periods of time. They cannot ignore arithmetic. Once supply, demand, and timing are known, prices do not move because of emotion. They move because the structure leaves no alternative. Samsung's disclosure forces the silver market into that position. The issue is not only that 340 million ounces of silver are being sold. The issue is how quickly, how visibly, and under what conditions that selling occurs. Silver is not an illiquid market, but it has limits. On an average day, global silver markets absorb roughly 8 million ounces through a combination of industrial use, investment demand, and trading activity. Samsung's liquidation plan compresses years of supply into weeks. Selling 340 million ounces over a short window means adding several million ounces of extra supply every day. That additional volume must be absorbed by buyers who already exist, or by new buyers willing to step in. But buyer behavior changes when future supply is known in advance. This is the critical point. When markets believe selling is temporary, buyers act. When markets believe selling will continue, buyers wait. Samsung's filing removed uncertainty. Holding silver no longer makes strategic sense once it is no longer required for production. Inventory becomes exposure. Exposure becomes risk. The rational response is liquidation. This is how isolated supply becomes systemic supply. As each participant prepares to sell, buyers become even more cautious. The imbalance widens. The market searches for a price where buyers are willing to absorb not only current supply, but expected future supply as well. That price is not arbitrary. It is a function of cost curves. At lower prices, marginal silver mines become unprofitable. Production slows, some operations shut down, supply begins to contract. At the same time, certain forms of demand respond positively to lower prices. Jewelry demand increases, some investment demand returns once prices stabilize. Equilibrium emerges only when these forces align. Samsung's internal analysis suggests that this balance occurs near $28 per ounce. Not because $28 is symbolic, but because it is where enough supply exits and enough demand reappears to clear the market. Above that level, surplus persists. Below it, production cuts accelerate. This is why the number matters. It represents a clearing price in a world where electronics no longer consume silver at scale. It reflects a market adjusting to permanent demand loss, not temporary oversupply. The most important takeaway for decision makers is this. Once demand destruction is structural, recovery dynamics change. Prices do not rebound quickly. They stabilize slowly. They remain range-bound until new uses emerge or supply permanently contracts. Sentiment cannot override this process. Investors who focus only on historical price levels miss the shift entirely. They assume mean reversion without asking whether the mean still exists. Markets do not revert to conditions that no longer apply. Samsung's disclosure forces a reassessment of silver's role in the global economy. It removes one of its most important demand pillars and replaces it with a more efficient alternative. That change cannot be undone by optimism or delayed by disbelief. Part 4 closes the loop. What began as a quiet filing becomes a structural reset. What looked like a normal market becomes a mispriced one. And what many interpret as a collapse is, in reality, a recalibration to new fundamentals. When demand disappears, prices must follow. And when the timeline is known in advance, the adjustment does not wait. The countdown is not driven by fear. It is driven by math.